Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to the third chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act of 2017. This chapter will cover state and local tax deductions. If you itemize your deductions on Schedule A, the state and local taxes are claimed in the section entitled Taxes You Paid. The taxes that are deductible are state and local income taxes, or state and local general sales taxes, state and local real estate taxes, and state and local personal property taxes. These are the same items that were deductible in prior years. So, what has changed? On your 2018 tax return, the total state and local taxes maxes out at $10,000. Therefore, you will receive no tax deduction benefit for state and local taxes paid in excess of $10,000. This will be a major reduction in total itemized deductions for many people. Since this is the only major change to this section, we will take a few minutes to review what can and cannot be deducted. State and local income taxes you can deduct come from withholdings for state and local income taxes as shown on your Forms W-2s or Forms 1099s. Now note, you can claim the entire amount of withholdings as a deduction in the current year even if you anticipate a refund. Estimate tax payments you made during the year. This will include the estimates made in January 2018 for 2017. The deduction is based on the year the payment was made, not the year the estimate is for. If you filed an extension on your 2017 state or local income tax return and made an additional tax payment, you can claim this payment for the current year. If you had additional taxes that you paid during 2018 for amounts due on your 2017 taxes and local income tax returns, or for adjustments to previous state or local income tax returns, you can claim these payments for the current year. Now, some states require contributions to state benefit funds, such as disability funds, workmen's compensation funds, unemployment funds, and family leave programs. These contributions are considered state taxes for this deduction. If you live in a state that does not have an income tax, well, lucky you. So you have the option to claim the general sales tax instead. Actually, anyone has the option to choose to deduct the general sales tax instead of the state income tax. Sometimes this will calculate to be a higher amount than your income tax. If you live in areas where the real estate taxes are high and will eat up most or all of the $10,000 maximum, it would be an advantage to select using the general sales tax option. This way, if you do receive a state or local income tax refund, it will not have to be claimed as income for the 2019 tax return. Check with your tax preparer to determine if this is the best option for you. If you do choose to use the general sales tax option, then it can be calculated in two different manners. First, you can maintain all your receipts for the year and claim the actual amounts of sales tax paid for the year. Or, you can use the general sales tax deduction worksheet provided in the 2018 instructions for Schedule A. This worksheet uses amounts from the optional state sales tax tables based on your income and family size. Family size is based on the number of individuals and dependents listed on the tax return. The The tables have different calculations for each state, so make sure you use the proper section. Read the worksheet carefully, as you may be able to add additional amounts for local taxes based on where you live. Keep in mind, you can either claim income taxes or sales taxes, not both. You can claim real estate taxes that you paid on property that you own. If you have your taxes in an escrow account as part of your mortgage payment, the amount you can deduct is the actual amount of tax paid out of the escrow for real estate taxes. This should match the assessment. It is not the escrow amount you pay each month. There are some amounts that you pay concerning your real estate that you cannot deduct. These are foreign taxes that you paid on real estate. Your local area may assess charges on your property tax invoice for services they provide, such as trash collection, water usage, or mowing of public space. If these charges are itemized on your invoice, they are not deductible. If your local government issues assessments in addition to your real estate taxes that are designed to improve property value, such as new roads or new sidewalks, then these assessments are not deductible. If the assessment is designed to repair or maintain these infrastructure items, then they are deductible. The key is if the assessment is designed to or anticipates an increase in your property value. In addition to real estate taxes, some jurisdictions impose taxes on personal property such as vehicles, boats, and trailers. These taxes are deductible if they are paid by you based on the value of the property and imposed on a yearly basis. Some states charge an annual fee for your vehicle. The part of this fee that is based on the value of the vehicle is deductible as personal property tax. The other amount, such as a flat charge license fee based on the weight of the vehicle, is not deductible. The key is based on value. If the state or local government charges you any fee based on the value of the property, it is considered a personal property tax and thus deductible. There are taxes that we pay, but unfortunately are not deductible. These are federal income and excise tax, Social Security and Medicare tax, federal unemployment taxes, railroad retirement taxes, customs duties, federal estate and gift taxes, other state and local taxes not associated with income or property value. Some examples are gasoline tax and car inspection fees. Lottery tickets. Just to be clear, because it may seem like a tax, but it is not. Taxes you paid for someone else. It must be your tax bill or anyone listed on the tax return, not someone else's. And license fees such as mayor's license, driver's license, and pet licenses. Remember, the total amount that you can deduct for taxes paid by you is $10,000. So, I must warn you to beware. When the bill was passed back in December of 2017, immediately people tried to devise schemes that will help the taxpayer to get around this new limit. The IRS has been keeping a close eye on these schemes and closed the door on most all of them. A couple examples are prepay real estate or property taxes in advance. This was one of the first ones out of the block. The bill passed on December 22, 2017. Since there was going to be a limit for 2018, many people felt that they could pay their 2018 real estate and property tax bills prior to the end of the year to take the full deduction on their 2017 tax return. The bill was paid in 2017, so it should be deductible for 2017, right? Wrong. The IRS determined that taxes cannot be deducted prior to the year they were imposed. So, 2018 taxes could not be deducted until 2018. If you did claim your 2018 taxes on your 2017 tax return, the IRS may adjust your return and deny these deductions. Also, the way I read the instructions, you may not be able to reclaim them on your 2018 tax return because they were not paid in 2018. The instructions read, only taxes paid in 2018 and assessed prior to 2019 can be deducted for 2018. The IRS quickly ruled on this last year prior to the tax filing season, so I hope you didn't get caught in this trap. Many state legislatures even got into the act to help the taxpayer get past this deductible limit. Several states passed laws that allowed the taxpayer to take a tax credit if they made contributions to certain charities. This would reduce their state income tax, and then the taxpayer could claim the full charitable contribution. This seems reasonable, but the IRS saw this as just a ploy to circumvent the $10,000 limit on state income tax deductions. In August of 2018, the IRS issued proposed regulations IR-2018-172, which stated that your charitable contributions must be reduced by any state or local income tax credit received or anticipated to receive as a result of the contribution. This basically negates the benefit of these new state laws. I just ask for you to be wary of any tax loophole ideals, as the IRS is keen on making sure people do not circumvent the intent of the new law. So, if you hear of any, please consult your tax professional to make sure you do not get in trouble. In the tax section, there is a line for other taxes that is allowed above the $10,000 limit. These taxes are very limited in scope, but here are a couple of examples. If you paid foreign income tax and are not claiming the foreign tax credit on Form 1116, you can include this income tax amount here. Note, the taxes paid to a U.S. possession is not considered a foreign tax. It is considered a state tax back on line 5A and subject to the $10,000 limit. Also, if you paid generation skipping tax, you can include them as an other tax. Thank you for watching this chapter covering state and local deductions. We greatly appreciate your time. Join us next time as we will be covering home mortgage interest. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.